Hi, this is Georgiana Fung of Cirrus Research. Here with some key highlights from the latest Cirrus Signals report entitled Lower Estimates Offer Ballast to Equity Signals. This is our monthly publication that covers the macro indicators that are accustomed to our work and form the basis of our strategy. By and large, nothing has changed between this month and the last, but there are some contours of the market that we'd like to highlight to you. So overall, we are still overweight equities, large cap, a slight growth bias, but not by a whole lot. And also the risk indicators are also supportive, including our risk appetite model and also market crowding. They're both neutral. So by and large, we do still have a favorable stance on equities with the allocation at 65% equities and 35% bonds. It is not extreme as a few months back, but it is still constructive for equities. And what we've seen is a continuation of a favorable risk backdrop for equities, including some of the fixed income signals that are also favorable to equities as well. What's different though in the past month is that we've noticed expectations have really come down, which is the key highlight from our piece this month. Expectations for large cap stocks in terms of sell side estimates, earnings estimates, have been cut compared to last month. So in terms of upward revisions, they were at 40%. Now they're at 28%, which is below average. So that means 3 out of every 10 estimates were revised higher over the past 3 months. And that is huge considering that we have not seen such a big drop in a while now. And, the adjustments of expectations to the slowdown in the economy is, I think, supportive for equities in general. So that is for the equity allocation. Another point we want to highlight to you is the Cirrus style oscillator, which determines the growth versus value allocations. By and large, nothing has changed, but we do notice an uptick over here in the past couple of months, and that's because how strong the cyclicals have run. But the bigger picture is that with the Fed on an aggressive path of tightening, and higher multiples being punished, we do see this lean away from growth. So this is the big picture here, but the model is picking up that cyclicals have really run over the past couple of months. But by and large, though, nothing has changed with our macro indicators. We're still positive on equities. We're still positive on large caps, and also positive on this lean away from growth stocks. So with any questions, please feel free to ask, email, call us. We're happy to help you. Or if you want more details with the report, please feel free to go to our website. Thank you.